catch up here.
Just get rolling. Yep.
Okay. All right, so today we're going to cover some tax items. So I know it's not the greatest topic, but I think we'll offer some insight here on assessments, exemptions, credits. We'll also cover in DC and Maryland just a quick recap on some transfer and recordation tax exemptions. But I think the assessment section is something that's goes by the wayside a little bit. We understand obviously some of the aspects of assessments, but there are a lot of exemptions and credits out there in DC and Maryland, in particular, Virginia, not so much, that may be applicable to your seller, and it's something to be aware of for settlement, or it's something that may be applicable to a buyer on a transaction you're handling, and it's good insight to tell them to go ahead and apply for something that may be helpful for them on their taxes moving forward. So just a quick intro here. Again, I'll let Todd introduce himself. You're on mute
If I
again,
can
Todd.
get myself off mute, I will. So that's self-explanatory, but know many of you on here I see. So Todd Ewing, the owner of the company, and we are glad to have you guys aboard. We got a lot of information to share here today. Luke's really dug in, and I think the overall purpose of these things, again, is just to kind of bring awareness to folks. We see a lot of times that we'll get a contract in, and there's there's a situation where the parties involved, including the agents, are unaware that a buyer may qualify, say, for a DC tax abatement, or they may qualify for a DC recordation tax reduction, that sort of thing. And so those are the things, we catch those and bring them to the attention of the parties. But I think it's important for agents to, try to have a grasp on all this before the contract is executed and ratified. Anyway, I'll turn it back over to Luke, and thanks for joining us.
And I'm Luke. I'm the COO and settlement attorney here at Federal Title. I've been here 10 years and kind of done it all, processing, post-closing, everything. So I think I know a little bit about each aspect here. So I'll try and give my insight where I can here. So we'll get started on DC for the most part. So we'll go from DC to Maryland to Virginia. If you have any questions, again, jump in at any time. So DC, we'll start with just assessments generally. So DC properties are assessed annually. Property owners are notified before the tax bills come out in March. The assessment division uses the mass appraisal process. So question we often get is, how are properties in DC actually assessed? So the assessor's going out there yearly, they're doing the reassessments, and they're incorporating one of three approaches, really, which they call the sales comparison approach, the cost approach, or the income approach. For the most part, and from the information I've gathered from OTR, they basically look at the sales comparison approach, which is basically just looking at comps in the area. And then they're kind of using that data to give an assessment based on the comps. The other two kind of lesser used approaches are a cost approach and the income approach. So the cost approach basically is the cost to replace or reproduce the house. So you're looking at the value of the land, the construction, everything that gives them a value. The income approach would be estimating the potential rental income, and then they apply a capitalization rate to get them a value. So that's a lot lesser used now in DC. Basically, we're looking at a sales comparison. So they're looking at comps. Typically in DC, assessments do run lower than purchase prices. I would say that's almost always the case. If you end up in a scenario with a buyer or a seller that's telling you that their assessment is coming higher than what they recently purchased the property for, may be worth your advice to tell them to file for an appeal. Next here, we're going to get into tax classes with the district. So basically all the residential property in DC that we transfer on a daily basis falls under the Class 1 residential property. So Class 1 residential property is taxed at 85 cents per hundred. You'll see there Class 2 is commercial classes, and this is all available on OTR. You'll be able to see on the tax bill what class the property is designated as. So Class 2 commercial, you have $1.65 per hundred under 5 million, 177 per hundred from 5 to 10 million, and 189 per hundred above 10 million. And then you have Class 3. And if you've ever dealt with Class 3 with OTR, it's not fun, and Class 4 is even less fun. But vacant property in DC is categorized, and they up the tax bill here from the residential rate of 85 cents per hundred to $5 per hundred. So it's a pretty substantial increase there, and blighted even more so, $10 per hundred. You would think that DC would take into account things like construction, renovation, and not switch tax classes, right? There's obviously work going on at the property. Well, unfortunately, it's never quite that easy in DC. So for investors out there that are renovating or new construction, or not new construction, but just large renovation, typically DC will go ahead and change the tax class from Class 1 residential to Class 3 vacant. And then an application needs to be made that states that the property is under renovation or under construction to transfer it back to Class 1. But the assessor goes out and sees that the property is being renovated. They still go ahead and change to Class 3. In a scenario where you have just residential property that is reclassified to Class 3, the seller of the property, typically before closing, needs to go ahead and move forward with the application to OTR to reclassify the property to Class 1. Those are typically granted in somewhat of a timely fashion. And then once the purchaser has bought the property, they also need to complete an application on their end that shows that they're using the property for principal residence use. Typically, they will ask you to send a utility bill or something after the first bills come out to you as a buyer. That being said, just simply purchasing the property and us filing the homestead isn't enough. So both sides of the transaction need to complete the applications to classify from Class 3 or Class 4 back to Class 1. Next here, I'll get into tax credits and exemptions. So there are a ton in DC, and a lot of these I don't think are well known. So you can see basically what's on the screen here: assessment cap, first-time home buyer for recordation tax, historic properties get a credit. Everything here does need to be applied for. Homestead deduction, homeowner renter property tax income credit, limited equity co-op, lower income homeownership tax abatement, property tax deferral programs, and et cetera. You can see everything there. And I will send out, along with the recording of this video, we'll send you out kind of a cheat sheet that has links to everything as to their qualification criteria and how they're applied to for clients. That way you have those moving forward. But we went ahead and pulled out some of the more common ones here. So we'll look here at the assessment cap credit. So in DC, this is incorporated into the homestead deduction that's filed by usually the title company at settlement. So the real property cannot be taxed more than a 10% increase in the property's taxable assessment each year. So you're limiting the taxable assessment throughout your ownership. The homestead deduction, the rates have gone up quite substantially over the years for your relief there. So for 2025, they're exempting $89,850 of the total taxable assessment, which equates to about $763.72 per year in a tax reduction. The senior or disabled owner real property tax relief is a huge incentive in DC. So the qualification criteria is 65 years of age or older or disabled, and it entitles the person to a 50% reduction in the property taxes. So there is an income threshold that goes along with that. So you can see the 2025 income cap there. That's gotten a lot more generous over the years from DC. So I think this one is a little more sustainable. The senior cap is like the assessment cap credit for the homestead, but for people that also qualify for the senior or disabled real property tax relief. And that limits the increase on your assessment year over year to 2%. So if income is under $50,000, the homeowner can also defer property tax in its entirety as well if you meet that 65 or older or disabled criteria. Then you have the trash credit. So if you're in a condo or you are in a single family that does not utilize the DC public trash, if you have a private trash company, you can also claim an exemption of $133 per year in 2025 for a trash credit there. So we'll talk about, I just wanted to throw this in, obviously not property taxes, but here are the new criteria for DC first-time home buyer for the reduction to the recordation tax. And then for the tax abatement program, so in 2025, the purchase price limit has been raised to 753,000. The household income limits were raised a bit as well. So for one person in the household, it's 194,940, and for two, it's 222,840, and that does continue up to more people, and that's listed on the application there. But in most scenarios, we're seeing one or two people. So it's going to take into account all the household members. So not just the people on title, so anyone living in the household. And it reduces the recordation tax at closing to 0.725% of the sales price. One big note on this one, G4 visa holders are eligible for this. At closing, they'll need an employment letter that shows that they're a G4 visa holder, that they're gainfully employed. And typically we'll see this in cases of, like, for example, the World Bank employees. So they will not be filing 1040s. They're exempt from those criteria items that DC would typically look at for the homestead to verify a principal residence. So they'll just ask for an employment letter at closing. That way they understand the scenario and will approve the DC first-time homebuyer reduction there. So the tax abatement, separate here, the 2025 purchase price limit has gone up to 552,000. Household income has gone up to something that actually makes a little more sense this year, finally, to 82,200 for one person and 93,900 for two people. So again, with the tax abatement, the purchaser is exempt from property tax for 5 years, and that will start on the next tax year cycle. So the next closest October. And they're also exempt from recordation tax at closing, and the seller credits the buyer with the seller's transfer tax. So instead of paying the transfer tax to DC, it's credited to the buyer at settlement. If the property is within certain economic development zones, those household limits increase a bit. And again, that'll be included in the cheat sheet. We'll get you out a breakdown for every amount of people that qualify, the income thresholds and everything there as well.
Luke, if I can just jump in here real
Yeah.
quickly, just back up a second. And please pay attention to the caps, the purchase price limits here. We've had a few contracts come in where, you're just outside. For example, on the first time homebuyer DC recordation tax reduction, the contract comes in at 755, right? Now you're $2,000 over. Otherwise, they would have qualified. Same with the tax abatement. We've seen contracts come in just slightly over the 552. Now the buyer doesn't get to take advantage. So just pay attention to those purchase price limits there. It's very, very important. So that's all I got.
Cool. All right, so I'll push here into recapture tax. So I feel like recapture tax is something that's a little unknown in the industry. So recapture tax is the collection of property taxes at settlement for exemptions that were granted to non-qualifying tax accounts. So basically, in the most common scenarios we see in DC, you have someone who bought this as a principal residence and now they're renting out the property and they never terminated their homestead deduction. So basically what DC is going to do is, come settlement, they're going to issue a recapture tax bill, and they're going to go back to the first year that they can determine that the property no longer qualified for the homestead, and they're going to tax on the full assessment. So they're going to remove the homestead deduction and they're going to back tax. The same thing happens if you obviously moved out of state, or estates are the biggest one where we see recapture tax. So typically you have someone who is elderly living in the property, and this one can really be kind of a doozy at settlement for a seller. The reason being, most often, if we're looking at an estate, they likely qualified as well for the senior citizen deduction also. So the tax bill was likely cut in half now for however many years. Once the decedent has passed, the homestead really should be removed from the account. Obviously, that's not something anyone's really thinking about in that time period. So it typically is not removed. And then a year, 2 or 3 years later, when the personal representative goes to sell the property, they're hit with a massive recapture tax bill. So at settlement, we try and identify these early. Typically, if we're in a scenario where it's a recapture tax bill is commonly issued, we'll just go ahead and hold an escrow, and that way it's expected. That way, after settlement, it's not a scramble basically to get DC money that was already paid out as proceeds. It would be nice if DC would send this to us when we requested tax certs. I'm sure a lot of you are thinking that, well, yeah, you request a tax cert at settlement, right? To see what the bill will be. So DC typically does not update on the tax certs to show for recapture tax, and they wait until the deed is actually recorded to go ahead and update the tax account. So very often we'll have a recapture tax style file where we've held an escrow and the tax cert comes back clean with no recapture tax. The deed goes on record, and then a month later, the account gets billed for back taxes for however many years. So something to just think about or make sellers aware of if you're in one of those scenarios where they may still have a deduction on the account that they're not entitled to any longer. So next here, we'll get into Maryland. So Maryland is a little different than DC as far as assessments. So Maryland properties are divided into what you can think of as 3 assessment groups. So each year, a different group is assessed. Maryland property tax rates run roughly to 1.3% or so of the assessed value. The tax rate, that's because the tax rate is actually comprised of multiple rates that make up the actual base rate. But the most of the metro area is going to see the 2 tax rates there. So you have the state tax rate at the 0.1120 per hundred and the county at the 103 about per hundred. So that's how you get this phase-in assessment. Since they're reassessed in these 3 groups about every 3 years, you get that phase-in assessment that you can see on SDAT that shows you the phase-in over the next 3 years. So I have some not fun facts here, some fun, not fun facts. 2025 is Group 1's assessment year. Group 1's assessments will average a substantial increase, you can see there, and 97% of the properties in that group will see an increase. Group 3 saw an average increase of 23.4% last year. Group 2 will be reassessed next year. So here you go. That's a big reason to go ahead and apply for your homestead. So it's going to cap your taxable assessment portion there still to the 10%. So next here, Maryland has quite a few tax credits and exemptions here. So the notable ones people are aware of, I think, are the homeowner's property tax credit and the homestead. But you have the disabled veterans exemption, surviving spouse of military casualty exemptions, blind exemptions, charitable exemptions, improvements for health or medical conditions. So there's a lot that can be done in DC to lower tax bills when these specific exemptions do apply. Like we did with DC, I'll get into kind of the 2 common ones here. So you have the homeowner's property tax credit program and the homestead. So the homeowner's property tax credit program credits against the homeowner's property tax bill if the property taxes exceed a fixed ratio of the homeowner's gross income. So the one note there, your net worth cannot exceed $200,000. That's not including the property itself, but it's including any assets. And then the household gross income can't exceed the $60,000. The homestead doesn't have any qualifications and just should be applied for by every homeowner purchasing as a principal residence. But it limits the increase again to 10% every year. And new purchasers of properties will be mailed the homestead application by the department. And basically, they'll do that once the deed is on record. All of the tax records have been updated. So that's typically something they'll get in the mail, I don't know, about 6 months or so after settlement. The Maryland homestead is never going to be applied automatically, even if it's filed for as a principal residence in the land records. It's something that absolutely needs to be completed by the buyer and then sent back to the county there. So just again, we'll dive a little bit into transferred recordation tax program. So everyone, I think, is aware of the Maryland first-time home buyer program. So as long as you have never owned property in Maryland as a principal residence, you are entitled to an exemption from the state transfer tax. One thing that people don't know, I think, as much is a buyer who is basically a co-guarantor of a mortgage that is not occupying the property can still qualify for the Maryland first-time homebuyer program. So you can think of it as possibly parent and child, where the parent is on the loan just for purposes of qualification, but is not living in the property and may not be a first-time homebuyer themselves. but they can still qualify so long as they're solely on title to guarantee that mortgage. Recordation tax, this is something you probably don't realize. Most title companies aren't going to break this out for you, but purchasers purchasing as a principal residence in Maryland are exempted from the first 100K of recordation tax. So that's typically factored into the recordation tax figure that you're seeing already on your settlement statement. And that works out to about $450 per side of the transaction. So both the buyer and seller get a reduction of about $450 per side. And then we'll get into recapture tax in Maryland. So recapture tax in Maryland does not occur as often as it does in DC. Reason being, Maryland won't look back at the homestead, where DC's recapture tax really is very homestead dependent. Maryland's is not. So the most common scenario is the homeowner's property tax credit program. That's the one where that's income driven based on your tax bill. There is the ratio of your income. So if you're selling the property and you currently have a homeowner's property tax credit based on the income threshold there, you're going to lose the exemption for the entire period that the property is being sold. So if you are closing in September from July 1st through December 31st, the property will be retaxed or recaptured at the full tax rate. So you'll lose the exemption that's currently on there. So that means the seller is going to have to come up, obviously, with extra tax money from July 1st through that settlement in September, and then the buyer is going to have the remainder share there. The one good thing about Maryland that's a little different than DC is that on SDAT, there is a special recapture notice on every page, and it'll say yes or none. I'm not saying it's always correct, because a lot of times it does say none, and we will ask the county and they'll come back with a recapture amount. But at least some of the time, they actually will note if it's subject to special recapture. Again, same calculation as DC, just on the difference of what would have been owed at the full rate versus the exemption that they were getting. Virginia is a little different than both DC and Maryland here. So by state law, cities reassess every 2 years, counties every 4 years. Tax rates I'll just focus on the metro counties here. So Arlington, City of Alexandria, and Fairfax, you can see the rates there for this year. Assessments are mailed January or early February for Alexandria. The one thing that is very interesting with tax rates in Virginia and these three localities in particular is every single year, Arlington, Alexandria, and Fairfax vote on the tax rate. So the tax rate is up for discussion every April and is voted on by April, and then the bills go out typically mid-May. So a little different than DC and Maryland there. But the assessment exemptions, DC doesn't offer a whole lot, as you can see. So you have tax relief for seniors and people with disabilities. So each county has different qualification criteria, but the constant here is 65 or older or permanently and totally disabled. So that's everything for today. I know that's a ton to get through there very quickly. Again, I'm going to send out cheat sheets for everybody. That way you have something a little more compact and maybe a little easier to look at. And it'll include links as well to all of the different programs and criteria for those programs, so you have something to reference quickly. But again, I know we've said this in every meeting now. Close It, if you want to use the Close It app for buying, selling, net sheets, buyer estimates, it's free now. You still need to make an account, but you're no longer required to pay every month for it. So you'll just log in, free to use moving forward now. And then next here, we have the June 3rd rendition of this meeting coming up. So June 3rd, 11:30 a.m., we're going to go over surveys. Nobody loves to look at surveys because nobody understands exactly what's happening in the survey. And so we're going to get Patty Aiken on. She's with Exacta Land Surveyors, who is formerly Snyder and Associates. So she will go over surveys. She's going to give kind of a quick and easy breakdown of main issues to spot on surveys, and some of the more important items that sometimes go overlooked. So I think that'll be a helpful episode for everyone and a good reteach on what we're looking
Hell,
for in those.
I might even learn something, Luke, after 35 years of looking at surveys. I'm
I'm right
hoping.
there with you.
Yeah. All right.
So that's everything for today. I know, again, that's a ton of information to get to you quickly, but that's the point. Quick 30 minutes, not waste your whole day. And then we'll get all the corresponding information out to you. Again, all of these recordings after all of these videos go up on Federal Title's YouTube channel. They'll get sent out as well to everyone who attended, and then we'll send out that cheat sheet here in the coming days. And obviously, if you have any questions, reach out to any of us. You can just email if you want. attorneys@federaltitle.com is an easy one to get any of us, or just give us a call. We're happy to discuss anything here. So appreciate your time, and we'll see you again on June 3rd.